Hello everybody, it's Stephanie Larson with Winans Investments. Typically I would be doing these videos with my partner in crime, but Ken is holding down the fort in Vegas, and I know a lot of clients have been asking for a video update, and we wanted to make sure that we got it out to you as timely as possible. Unfortunately, as you can imagine, not only is it quarter end, but it's been a couple very exciting days in the market. Today is not an exception to that rule. I wanted to really kind of touch base with everybody, let them know what we're seeing in the market, what we feel about it, and how we've actually been managing the portfolios through it. I think it's really important. As a quick little housekeeping thing, you all should have your overviews from us, our Q1 overviews. If you've not received it or if you're still waiting on it, let us know and we're happy to send it to you electronically immediately. The portfolios have largely hung up very well. A part of it is how we manage the portfolios through times like this. We have a very strict and robust risk mitigation protocols. For people that have been with us for a long time, you've seen us enact these on several occasions. For the newer clients, obviously this is your first kind of go with us on it, and it can be a little intimidating to see what's going on in the market, what's happening, and just what are we doing to protect everybody. And it's a trying time. It is a very difficult time. You know, in the last 5-6 years that I've been with the firm, we have been through a health scare that has caused a flash crash, obviously COVID. We have been through a economic one where the Fed has increased interest rates, and that's caused the 2022 kind of pullback, and that was not fun and also painful. And now we're having this one, which is actually a political based or political centric crash, essentially. It's a little mini crash. It's a recession, or not recession. It's a correction. Let me clarify that, please. The thing is that whether you agree with the policy or not, it actually doesn't matter. The ramifications of what's happening is being felt in real time. And I know it's politically driven because if you watched the market yesterday, which was Monday, it started down, 1,800 points. And then the tweet came out that possibly there could be a stay on the tariffs. And then it was a 2,000 point flip. And then the tweet came out saying, no, that was fake news. That's not happening. We're staying the course. And then the market turned back down. Today, it had a very strong day in the market. And then also it is now pretty much petered out throughout the entire trading day. So now we're flat to slightly low, and actually in some of our stocks, but the indices, I have the market on right now. Our indices are now flipped down negative. The NASDAQ is getting hit pretty bad. One of the things that we do, which is part of our risk mitigation protocols, and I've heard this from several clients, they're just like, hey, it sounds like, or it looks like our portfolios are holding up better than the market. They are. The market's down well in the double digits. Our portfolios are down maybe the blends about 5 to 6, maybe. So part of what we do when markets start to get volatile and aggressively volatile, we will first start trimming stocks. In December, the Santa Claus rally kind of died at the end, the last few weeks of the year. It wasn't anything major. January started kind of oscillating flat. And if you look at the January barometer, it actually is a fairly good indicator of what to expect throughout the year. But that's with all things staying the same. Obviously, this is a self-imposed or a macro event that's causing this market volatility. But so we already kind of knew that this year was going to be, kind of channel-based trading. We really didn't think it was going to be a third year of excellent returns. We didn't think we would really get hammered too much or finish the year negative, but it was going to become a lot more management where you had to really kind of play inside of the lines of what the market's going to give you. Well, what we started doing was we started trimming stocks a long time ago. We got out of big tech over 6 weeks ago. We got rid of our Amazon position. We cleared out a lot of it. We still have, I think, some Netflix, but we cut a lot of this stuff in half. We got rid of Nvidia. And the thing is that you can't always just bet on those big names. The rotation was a real thing. And unfortunately, some of the names that we rotated into, we then had to also kind of rotate back out of. And we kind of felt like we were a little bit on a merry-go-round, like you were hopping off and then you're hopping back on and you're kind of like, where's the leadership here? That first it was financials and energy, and now financials got hit, and this was a huge part of it. So it's been a real tough time navigating this market where you don't want to be whipsawed all the time. So you have to kind of just stick to the way that you manage the money and go with your beliefs and your conviction and your research. So we rotated, we cut names, we've increased our cash quite a bit. Most of our equity allocations are in around 20%, 20-25 if you count the hedges. We had hedges on for quite a while. It really helped kind of mitigate the volatility. We raised or lifted the NASDAQ hedge on Friday. So that was PSQ. You would see that in your portfolios. Yesterday, we lifted SH, which was the hedge on the S&P. Our research is telling us that the market is incredibly oversold right now. And whilst that doesn't mean we're calling the bottom, because we sold the hedges and we wanted to lock in those gains, which they were in the money, 3 to 4%. We wanted to stay in cash because we're still not certain that the volatility is over, but we don't want to bet against the market. It was good timing for the start today because the market's opened up 2-3%. Now, obviously, that's reverse course throughout the day. So we don't want to bet on the directionality of the market at the moment. We just want to be cautious. We want to get out of the names that we didn't like anymore or that had turned against us. We want to reduce exposure to names that were on our watch list that we've had a lot of concerns about. We did hedge, we've raised a lot of cash, and we're going to sit and wait and watch as the market picks a direction. And it might not even be the market, it might be company specific. And I actually really feel like that's the more closer to what to expect. It's not, oh, I'm going to just bet on the S&P is going to go up. It's had enough to the downside. It's going to go, I think these 10 names are doing really well and they're holding up through all of this volatility. These are the 10 names that I want to put my investment with. So it has been a challenge. It really has been, but we are staying on top of it. And our risk mitigation protocols are the reason why we always outperform in down markets. I do ask that you please don't challenge us on them. We had a couple clients that specifically requested that we don't put hedges in their account. I vehemently disagree with it, and I really wish that you guys would let us do that, but we respect your decision. But it's because of special circumstances like this that we use them. We don't lightly go into them or just think, hey, let's put these on and just see, we'll kind of play both sides of the market. That's not what we're doing. We're putting them on because we have some real concerns, and we were correct. Now, the part of the reason why the market has corrected so much is because the tariffs were a lot higher than we expected. And again, I don't really care if you agree with them or don't. We have clients on both sides of the political spectrum, and they have their opinions about it. That's fine. The point is, it's an increase in costs. And I can tell you exactly the things that we're concerned about as we're watching this market play out. If the tariffs stay on, the cost will increase. That's just reality. The companies that have tariffs put on them are not going to eat the cost. If they did eat the cost, then they would have to probably eventually cut employees and staff because their margins are now much smaller, if not completely wiped out. And then they're going to have to take care of their financials and their fundamentals, right? So either the company eats it, and that instantly incurs some economic hardships or employment hardships, right, on our economy, or they pass the cost down to the consumer, which then could also affect the way that they consume. And that is the concern that I have. I don't know if many of you guys know, but my background is in economics. I have a double degree in economics. And, when you look at the US consumption model, the GDP, 2/3 of it is from consumption. We don't really make things in this country anymore. Not like we did during the Industrial Revolution. A lot of that got exported. It started when the market started to open under Reagan, and then through with Clinton with NAFTA. And a lot of big businesses have exported the construction or the making of everything that we consume in this country. Well, it made business sense. It maybe not for the American people, but if we bring back the building of things, the infrastructure back into this country, Maybe that makes things better, maybe that doesn't, I don't know. But when you look at businesses, they plan out things financially a year, 2, 5, 10, 15 years in advance. They have to. If you're going to make that type of investment into research or whatever it happens to be that you're doing, building a physical facility or whatever, they have to make those plans many, many years in advance. If you actually look at oil companies, they make their plans sometimes 50 years in advance, because you're not going to just start drilling a well just because you feel like it and you think that area will be good. You have to build all things around it, including the infrastructure. So this is going to be a difficult time. How long these tariffs stay on, it is going to negatively impact the economy, period. It's going to impact the consumption model of the US, which is the main driver for GDP. They did reassess GDP lower in January. Employment numbers are still holding up pretty well. For you that have watched the videos that I've spoken about that many times, because employment numbers are really going to matter in this country. Again, it goes back to the consumption. If we have all of a sudden an uptick in unemployment because economics have softened within the business economy, then all of a sudden you're going to see the consumption model change. The consumption model drives the US economy, period. 2/3 of the economy is based on consumption, consumer consumption. So that's what we're paying attention to. Yeah, the tariffs aren't fun, and it's absolutely sent the market in a tailspin. The markets like certainty. They want to know what's happening because business likes certainty. Like I said, they plan things out. That's why businesses like the certainty of what's happening. They want to know what the rates are going to be, and can they make that investment? Can they build that factory? Whatever it happens to be. And so that's the thing that is really going to affect what's going on and that we're paying attention to. Now, again, our risk mitigation protocols are extremely robust. We've enacted them. It has absolutely muted the downside performance in the portfolios by almost half, if not more. We're going to stay on top of it. We are trying not to get whipsawed. We don't want to call tops and bottoms. That's not what we're doing. We're going to try to keep our exposure to the market controlled in the names that we have conviction in. Heading into earnings season, I am nervous. I'm not going to lie. Seeing some of the effects of what's happening on the bottom line to businesses, that's going to be key. I think there won't be enough data in this earnings season. I think really it's going to be the next one, if I'm being honest, where if the tariffs stay on, then we'll see how it really is impacting businesses or not. Maybe some are fine, some are not. As a rule of thumb, when we're putting money to work, so when we're investing in new stocks, Ken and I really hate doing it right before earnings season. It's a huge risk that they just happen to miss and you get absolutely blown out of the water. It doesn't mean that on occasion we won't. We're just extremely cautious about it. We don't like to just jump in, right? Tea break. I think so. What we're going to be doing is we're going to stay on top of everything. We're really going to be choosy about the names that we like, that we want to be in. We're looking for leadership. We're going to be watching the economics, and we're really going to be paying attention to earnings. I think the earnings are going to really kind of show what the damage is underneath the water. Everything can be, fine and dandy above it. People say, hey, it's fine, we're weathering the storm, but numbers don't lie. And so that's what we're going to be focusing on and paying attention to. I want everyone to know that Ken and I are on top of all of it. I know this is extremely scary, especially the older you get. You don't have the tolerance to lose a lot of money. People don't want to go through another 2008 or a 2009 situation. They don't have the temperament for it or the ability to recover. If you are really concerned about what's happening, maybe changing your allocation is a good idea. It's something I'm happy to discuss with everybody. You shouldn't have sleepless nights or be worried about what's happening in the market and what can you survive, what can you tolerate. Now, we're doing our job, but if you really if you really believe that this is just too much for you, then let's lower the risk in your portfolio. Let's lower your exposure to the markets. I think that's the thing that's prudent, that makes the most sense to everything that's going on. I hope on some level that this really does make everyone feel a little bit better. We are very aware of what's going on. There's no surprises to us. And we're going to make sure that we do every single thing in our power to protect the portfolios and your assets. We've had multi-year gains here. Ken and I are not looking to give those back for any reason. And we want to make sure that everyone's safe. Now, on the fixed income side, I haven't seen any deterioration on the fixed income yet. A thing that could change that is if Jerome Powell needs to increase rates. I think the cuts that were forecasted for this year are completely off the table. If inflation picks up, and inflation, mind you, is simply the increase of costs of goods. You take a bucket of goods, you measure the cost from January to April, and you say, is it higher? That's it, right? So if the tariffs do cause inflation and the Fed feels they need to increase rates, then we could go through another bit of an interest rate cycle like we did in 2022. Because the way we manage the portfolios, we're not scared about that. We buy and hold. We make sure that we ride through the price fluctuations as they happen. As prices actually come down, it's a great opportunity to buy. I have seen extremely good paper to buy, and we're going to continue to stay on top of that as well. I'm always hunting in the market to see if there's something that I can get that's a great deal for all of our investors on the fixed income side. And for the first time since 2020, I am finding paper again around 8%. It's amazing. I haven't seen it in a while. And I've been living around 6.5% to 7% if I'm lucky. So to come up a full 1.5 on fixed income is excellent. So we're going to stay on top of the stock side and the fixed income side. We're going to let all of this play out, because since this is a politically driven volatile market, it also can change on a dime. And that's what we saw yesterday in the market, right? A tweet goes out, all of a sudden things change and the market just takes off. So we're kind of preparing for every eventuality that could potentially happen. And in the meantime, we're just trying to safeguard everything. So just know Ken and I are on top of it. We promise we'll do a joint video soon, maybe two weeks or something like that. We just want to see things kind of calm down, play out, see how earnings season starts to roll out, and then we'll do another check-in with everybody. And in the meantime, if you have any concerns, please do not hesitate to reach out. I really want to make sure that everyone's getting through this and knows that everything's okay. So I'll talk to you soon. Ken will talk to you soon. He also was on the radio last night talking about this as well. We will send the link out to the replay of the radio show so that you can also hear his thoughts on it as well, and we'll go from there. So stay safe. Don't worry. We're on top of it, and we'll touch base soon. Okay? Bye, guys.